Li Lu is one of the greatest investors of all time, but his lectures are impossible to find, making them extremely valuable. I found one. And not just any lecture either. Thanks to a former Columbia University student, we have notes from Li Lu's 2012 Columbia University lecture, and it's more impressive than any lecture we've ever seen before. In this video, we're going to walk through Li Lu's complete investing process in incredible depth, using two investments he's made in the past that have never been seen before. But enough beating around Aesop's bush. We've got work to do.
You guys have work to do.
Li Lu starts this lecture by outlining the three concepts that define value investing. The first of which is that stocks should be seen as pieces of businesses and not pieces of paper that get quoted and traded regularly. It's funny that he says pieces of paper when it's probably more relatable today to say something like pixels on a screen. Secondly, Li Lu introduced the concept of having a margin of safety. He says at its core, investing is really making a prediction about the future, which is inherently unpredictable. Lucky us. And if you need an example of that, you can look to my inability to pick winning Yada Savings lottery numbers. What this means is that investing should be a statistical process, and we should factor in a buffer just in case anything were to happen, because someday something will happen and it'll test our intellectual honesty. But how do we know that we've done enough research for ourselves to say that we have a prediction that's statistically in our favor? For this, Li Lu quotes Charlie Munger, who said, "I'll never allow myself to hold an opinion on anything that I don't know the other side's argument better than they do." That's Li Lu's benchmark and the theme for this lecture. Lastly, Li Lu says that the stock market, which he calls Mr. Market, is irrational and prone to mispricing opportunities that we can take advantage of. In previous lectures, Li Lu also added a fourth concept, which was Buffett's contribution and the concept of the circle of competence, but it appears he didn't use it in this lecture. I'd be very curious as to know why he didn't include it in this one, if there was a reason for it.
Well, that is a very, very good question.
Li Lu then swiftly transitions into his first example, which is his purchase of stock in a company called Megastudy in December 2004. Megastudy is an online education tutoring company based in South Korea. Through interactions with the students, we find out that the demand for tutoring comes from the fact that high schoolers take a college entrance exam that virtually determines their career prospects. The exam is a zero-sum exam, which means how well a student does depends on how well they do in relation to all the other students. And because high schoolers are required to attend the same public school and can't do private school, if they want to do well, it requires them to hire a tutor. Megastudy hires the best tutors, pays them a commission, and then charges the students a fee that's less than offline tutors, making it a more valuable product for less of a price. It's a wonderful business model that is clearly caught on, as reflected by the tremendous financial growth. But now what about valuation? When Li Lu was considering purchasing Megastudy, it was selling for about $18.50 in US dollars. With 6.3 million shares outstanding, it meant that Megastudy was selling for a market cap of around 117 million US dollars, which Li Lu rounded to 120 million. Of that $120 million, about $50 million was straight cash. In 2003, Megastudy had net profit of $15 million, which meant that for valuation, Megastudy was selling at a price-to-earnings ratio of about 8. And then if you back out the cash from the market cap, it was really selling at a price-to-earnings ratio of about 4. But that does not mean it's cheap. It's not conclusive yet. Li Lu always pushes people to ask more questions, like, why is it selling at a low multiple? Well, as it turns out, in April 2004, just 10 months before Megastudy was about to go public, and when Li Lu was looking at purchasing stock, the government announced their own program to offer online tutoring, with one major difference though. It was free. As a result, Megastudy's revenues in the first quarter following the news fell by 7%, and in the second quarter fell by 28%. And this is where we get to see an interesting look into Li Lu's grasp of human psychology. Li Lu informs us that the tutors that go through the government program will be paid a government salary. And while it makes sense for the average tutor to migrate to that job, for the high-quality tutors, they'll get more money through commissions with Megastudy. And if everyone's purpose is to get the best grade that they can, it doesn't really make sense to go through the government's program, giving Megastudy a competitive edge over the government's program. And that's not all, because they also have a competitive edge over the private industry, even if they're willing to pay a higher commission to tutors. And that's because Megastudy was one of the first and one of the biggest to provide the program, and there's a network effect. Think about it. If Megastudy has the most amount of students, then the tutors that offer programs will make the most amount of money. So they'll make more lectures, which will attract more students, creating this virtuous cycle, and becomes a winner-take-all environment. After doing all this research and seemingly going against the entire world who believed the government's free system was going to end Megastudy's business model, Li Lu decided to invest in the company. What's absolutely mind-boggling about this investment was that Li Lu purchased shares during the company's IPO. IPO stands for Initial Public Offering, and it's what happens when a company's shares first become publicly available. It's particularly rare to see a value investor invest in a company's IPO for many different reasons, but I'll leave Warren Buffett and Charlie Munger to explain why.
I don't think Berkshire's ever bought a new issue. I mean, the idea of saying the best place in the world I can put my money is something where all the selling incentives are there, commissions are higher, the animal spirits are rising. I mean, that's going to be better than 1,000 other things I can buy where there is no similar selling enthusiasm and the desire to get the deal done and extra commissions. That's the single best thing to buy on a given day. I mean, it's
I can't think of a time we've ever done it.
Yeah.
Ever bought an IPO?
Yeah, never bought one.
Yeah. How can it be?
They don't even call us.
Yeah, but how can it be the best single thing to use your money for in a given day is something that they got everybody in the world out pushing it. It just doesn't make any sense.
Although rare, it's not impossible to see a value investor invest into an IPO. Li Lu has said many times before that he has no self-imposed rule as to what opportunities he'll invest into, only that it fits within his circle of competence. In fact, early in his career, he even started a venture capitalist firm focusing on private companies. And it's this open-mindedness that rewarded him with the opportunity of Megastudy, which went up more than 10 times, and is almost as impressive as the next investment we'll look at. For the first time I've seen ever, Li Lu provided to the students an example of a stock he just invested into. They got to see an investment Li Lu was making in real time, and I hope none of them are kicking themselves for not buying that stock because, well, I can't ruin it, so let's look on. In 2012, Li Lu purchased shares of Amorepacific, an international cosmetics company based in South Korea that had a dominance in market share, mid-teens growth, high returns on capital, and no debt. But there is something askew here. The common shares and the preferred shares were trading at remarkably different valuations. You see, preferred stocks in America and preferred stocks in South Korea act very differently from each other. In America, they more closely emulate fixed income vehicles like bonds, whereas in South Korea, they act very similar to common stocks, but without voting rights. And to make up for those reduced rights, preferred stocks in South Korea are often offered at a discount and with a higher dividend yield. In 2011, Amorepacific made in net profit or net income about 327 million won. The common stock was trading at a market cap of around 8 billion won, which meant that it was selling at a price to earnings ratio of around 25. Meanwhile, the preferred stock was trading at a market cap of around 2 billion, which meant that it was selling at a price to earnings ratio of around 6. So what's the difference? Li Lu says that the only true difference in South Korea between the common and the preferred stock is that the common has voting rights. In the case of Amorepacific, it seems really irrational to place a 400% premium on the common shares because the owners have a majority interest anyway. Li Lu suggests that for some reason, the market is placing less value on the interest of earnings for the preferred stock than of the common. And to clue us in as to why that might be, we should check the financial statement. Now, I'm going to demonstrate this next part a little differently than the student notes because I think it'll make it easier to understand. Li Lu said that if you want to see the impact of preferred stock on earnings in financial statements, that you should look to a company that sets the golden standard, which in his eyes is Samsung Electronics. Samsung takes the net income the company makes, divides it between what's owed to the common shares and what's owed to the preferred shares. They then divide that amount by the respective shares outstanding to arrive at an earnings per share of the common and of the preferred, which are almost identical. Amorepacific, on the other hand, is doing it a little bit differently. They take their net income, subtract what's owed from the preferred shares, and arrive at an earnings per share that's based on common shares alone. Li Lu says it's very similar to how most companies treat junior securities. It's essentially like saying that preferred shares aren't included in earnings per share and that they don't have any claim to the company's earnings. but they do. Li Lu said that it reminded them of a debate on how to treat stock options. Until 2006, businesses didn't have to account for stock options as an expense. Executives argued that if options were an expense for accounting purposes, then they must be free. But that logic was flawed. In fact, Warren Buffett wrote an article about it in 2002. Buffett asked 3 questions. If options aren't a form of compensation, then what are they? If compensation is an expense, then what is it? And if expenses shouldn't go into earnings calculations, then where should they go? Li Lu said that you can apply this same reasoning to Korean preferred. If preferred shares are a form of equity, then what are they? If equity isn't a claim on earnings, then what is it? And if a claim on earnings shouldn't go into the earnings per share calculations, then where should they go? After doing his research, Li Lu concluded that the preferred shares do have a claim on the earnings and decided that it was selling for cheap enough for him to invest into. I looked up what happened to Amorepacific after 2012, and it looks like at its peak it was up 800%. And if he held it up till today, it's up 160%. Now, I didn't bother fact-checking the math and looking into how much this chart is actually showing us because we don't have the details of his transaction, so it really doesn't do us any justice. But it's impressive nonetheless. In his concluding remarks, Li Lu said that he shared these 2 investments in particular because he wanted to give the students a sense of what it takes to actually take an opposing view against Mr. Market. It's a very, very hard thing to do. He wraps up his speech by again quoting Charlie Munger when he said, "I'll never allow myself to hold an opinion on anything that I don't know the other side's argument better than they do." And that is Li Lu's 2012 Columbia University lecture. If you want to read the full transcript for yourself, I provided a link to it in the description below, as well as any other sources mentioned throughout the video and any corrections if we made mistakes in this video, as I'm human after all and just some guy on the internet, so none of this is advice. Thank you so much for watching, and if you enjoyed this one, make sure to check out our review of Li Lu's book and some of the other awesome content we have on here. Thanks for watching, and subscribe.